let's also welcome in our guest, Abhay Agarwal, who joins us on the show as we speak. Abhay, good afternoon, and thank you for speaking to us at NDTV Profit. A good day to speak to you, where you're seeing so much of resilience in terms of markets. Don't see that kind of fear from a technical perspective. Good amount of consolidation that's happening. What is your read at this time, taking into consideration where we are?
Good afternoon, Alex and Hiral. Great talking to you. I'm not surprised by this resilience. I mean, though I would not, I was budgeting for a knee-jerk reaction, but very happy to see there is no knee-jerk reaction to, to the ops carried out by our forces. I think there is, there was some bit of cap on market that was put up by the geopolitical tension over the last couple of weeks, because there was no surety of what kind of action, how deep, how big will that action be, what kind of escalation that will lead to. So I think, frankly, with last night's action, there is a bit of relief that, okay, now we at least know what action has been taken. So I think what we are seeing, the resilience is some part of that. There was a lot of money sitting on the sidelines, and I think that is probably now starting to come in, assuming that we are not going to see an escalation of a major kind, or this is not going to become a broad war. This will largely be limited to, hitting the enemy targets, very concentrated targets, not a wide range, conflict, and maybe some action at the borders, but nothing beyond that. So I think this kind of certainty, as it emerges over the next 2-3 days or next week, I would not be surprised to see a bigger relief rally that also takes in from here. The good thing to see today is also this kind of support to the market is backed by good volumes. So it's not a thinly traded day, which shows that money is coming in from domestic investors as well as foreign investors. So yeah, overall, I'm pretty happy to see this kind of response. Now it is, I think, in week or 10 days, the market participants and fund managers will start focusing on the results, aftermath, and what is the management commentary, what is the corporate earning growth going to look like. I think the conversation will probably start switching there now.
Point taken, Abhay. Abhay, this is Harsh Saita joining in. First off, Abhay, want to try and get your take with regard to how you would play on a day like this. Let's just assume you want to buy something. Would you hold off any buying at this point, or would you buy today? How would you look at it in the broader scheme of things? Because of course there is plenty of conjecture on what is going to happen next, right? And nobody is really sure. So there's plenty of uncertainty.
No, I think that uncertainty is par for the course, in any kind of market. So, but yeah, absolutely, it is elevated at this point of time, knowing what we know and what action has been taken. But, in terms of allocation, I would say that this is a market which has seen pretty bad times. We had very aggressive selling by FPIs in January, February, March also. Then the market started stabilizing in April, and now we are seeing more strength coming in, largely because of return of foreign investors. And though it is drips and drabs, but still it's a positive flow after a very long period of time. So as an asset allocator, I don't want to be under allocated to the Indian market. I don't want to be in a situation where I am trying to time the market. I think a lot of time people, when they look at Indian market, they go wrong because they try to time it to perfection, as if they know when is the right time to buy. And I think that's where investors who stay invested benefit from days or even weeks when the market goes one way, which is up, and then they benefit from that. The investors who try to time it too well or time to perfection, they exit the market, they miss the up days, up weeks, and as a result, underperform the market. So I think for any investor, it is very important to stay appropriately allocated to Indian equities. If you're an Indian equity investor, of course, bit of maybe 10%, 15% of cash calls you can take. You're trying to time the market, but frankly, my experience is a futile effort.
Okay, point taken. So don't time. If you have an idea, deploy today. Essentially, that's the message coming through. But Abhay, interesting times from a trading perspective as well. There's plenty happening on the India-US front. Of course, a resolution there awaited, and awaited in bated breath. In fact, pharma will be one sector which will really be waiting for what transpires there. But India-UK, and that's the key positive today. At least plenty of sectors buzzing on the back of that India-UK FTA. How do you look at it? How big of a positive is it for India from an Indian standpoint, and does it change the hypothesis for maybe a sector or two for you as well, fundamentally?
I think it is a giant size positive, and I think the impact of this will be felt over the next 1 year. I think from a signaling perspective, it is very important to note that the government has pushed through this UK FTA, which was hanging fire for last 10 years, and there was a lot of dogmatic calls that were taken that look, UK wants spirits, alcohol to be not duty free but lesser duties from 150%, and that is not something that we will accept. And there was a lot of posturing going on that. But the speed with which over the last 1 month this whole thing has come together, I think both from an immediate benefit perspective and from a signaling perspective, the government has sent a very strong signal to the global markets that we want to increase our share of global trade. We want to become equal partners. We will do whatever it is required to get into a situation where make in India for the world becomes a reality. And I think I would compliment the government to push through this and be seen as a very strong global player, in the other trade level. And I think this same signaling and the same thing will continue with the US government also. I'm pretty positive of that because
So
you
Abhay,
can't have a US again.
So Abhay, clearly, would it be right to say, number one, that the dynamics of the markets have changed with the FTA being signed? Because before that, fund managers, markets across were talking about putting your bets in terms of BFSI or the domestic-oriented sectors. And if that is the scenario now where dynamics have changed, which are the sectors would you start nibbling at?
We have already been nibbling here. Our biggest overweight in our model portfolio is the EMS space. So again, not by recommendations, but since these companies are part of our model portfolio, company like Dixon, Amber, Keynes, Sirma, because these companies benefited from the PLI that the government rolled out to make India self-dependent on a lot of things that we were importing, like TVs, mobile phones, electronics, computer equipment, laptops, routers, that kind of stuff, which we are all making in India and making at good scale. So what happened is that what started as a small experiment has scaled up big time. And that's why you have companies like Apple planning to make their entire US consumption of phones from India. So what that scale is doing is it is making us very competent as a manufacturer for the first time of equipment and products that the world needs and has typically been sourcing from China. So first time we have a situation where our companies which have spent last 5-6 years investing in building manufacturing capabilities are now globally competent players. They don't need subsidy support, they don't need other kind of support because we are benefiting from scale. So I think this is a story, India as a manufacturing hub across products. You've seen it in pharma, you've seen it in electronics, mobile phones. You will soon see it in other more complex products also. Once we have our own semiconductor packaging plant starting June, July this year, Tata's and Keynes. I think a lot of things will change dramatically and the world will hopefully see India as a manufacturing hub. So we are quite bullish on that theme, that India can manufacture not only for itself, but for the world.
Okay. And Abhay, finally, just trying to get a sense on what you would completely avoid at this point. What are you finding as that pocket which should not currently be touched for whatever various 2-3 reasons which which you can highlight?
Yeah, I think there are two sectors that we are very underweight. We have no holding in our model portfolio. And one is IT services, because I think that whole game of labor arbitrage, frankly, has outlived its utility. And unfortunately, our leading companies in IT services space have not innovated to the extent that they should have. They are behind the curve on adopting new technology. And as a result, the growth guidance is what it is, 0 to 2%. The margins are under pressure. The customers want 20% price discount. So it's a very tough situation that our IT services are going through. I'm hopeful that a year or 2 years, they will be able to become more competitive, but it will require a lot of reset at their end. So I don't want to pay 20 to 25 times price earnings multiple for these companies when they are guiding for a 2% growth. The second is the large FMCG players in India, companies which are trading at 45 to 60 times P multiple with a 2 to 5% growth, very anemic volume growth. And the reason is that they are probably not able to compete with the local brands which are expressing their own might in their own territories. So I think these are the two sectors which are very high priced valuation wise when you look at the growth guidance that they have over the next 1 year. So those are the two sectors I would avoid right now.
Right, interesting. Consumption and IT, two sectors that Abhay would be avoiding as well. Thank you, Abhay, so much for joining us on the show and sharing those views.